Hi traders! In today's video, we're going to share a simple breakout trading strategy for beginners. We'll discuss with you the strategy and look at some live examples from the chart. So if you're a day trader who is looking for a simple strategy that doesn't require you to monitor the chart every 5 minutes, then this video is for you. Breakouts are one of the most common trading strategies. They involve identifying a key price level you expect the price to break through, and then buying or selling at that price to take advantage. Generally, breakouts are used when the market is already near the extreme high or low of the recent past. The breakout trading principles discussed in this video are universal to all markets. You can apply the same breakout trading techniques to stocks, forex currencies, and commodities. Technical traders often use trading channels to assess whether to purchase or sell their positions. Traders also use the channels to evaluate existing market volatility. A trading channel is a chart pattern highlighted by two parallel lines bordering resistance and support within which a currency pair or a stock trade during a certain period. Within a valid uptrend trading channel, an opportunity to buy into the uptrend is indicated by subsequent bounces up off the support level at the point where the price touches the support level at least twice. Channel trading is a less exotic but popular trading technique for currencies. The reason why it can work is that currencies rarely spend much time in tight trading ranges and have the tendency to develop strong trends. By reviewing a few charts, traders can see that channels can easily be identified and occur frequently. A common scenario would be channel trading during the Asian session and a breakout in either the London or New York market opening. We've previously made a video where we traded the London and US breakout strategy 100 times. Don't forget to check out the two videos. I'll leave the link at the end of this one. There are many instances where economic releases are one of the most common triggers for a break of the channel. Therefore, traders must keep on top of economic releases. If a channel has formed and an important fundamental report is expected to be released, and the currency pair is at the top of a channel, the probability of a break is high. So traders should be looking to buy the breakout, not fade it. Channels are created when we draw a trend line and then draw a line that is parallel to that key level. Most, if not all, of the price activity of the currency pair should fall between the two channel lines. We will seek to identify situations where the price is trading within a narrow channel and then trade in the direction of a breakout from the channel in question. This strategy can be particularly effective when used before a fundamental market event such as the release of major economic news or before the opening of an important financial market. These are some rules for using this technique to find long trades. 1. Identify a channel on either an intraday or daily chart. The price should be contained within a narrow range. 2. Enter long as the price breaks above the upper channel line by 10 pips. 3. Place a stop at the lower channel line. 4. Exit the position when it moves by double the amount risked. In the short scenario, the trade is triggered when the price breaks the lower channel line and drops by 10 pips. The stop loss is set at the upper channel line, and we can aim for at least a 1 to 1.4 risk to reward ratio. It's important to have a dynamic and flexible take profit level, and that's why I'm sharing in a bit a simple and effective way that will help you to safely position the take profit level. Let's look at some examples. This is the Euro USD 15 minutes chart. We can notice a formation of a trading channel at this stage. We can see that the price has tried to break the support and resistance levels multiple times, but the key levels were solid enough to sustain and consolidate the channel. Let's proceed to draw the support and resistance levels to define our channel. Avoid spending too much time adjusting the levels, as it's rare to get a perfectly structured channel. Even experts will draw the same channel in various ways, but there will be a relatively small difference in terms of pips as we are working on small time frames. Once done, we're going to place 2 pending orders which are 10 pips away from the support and resistance levels. Always remember to place a stop loss level even if you are entering the market with a pending order. The market can be extremely volatile, and you'll end up losing your hard-earned balance if the price goes against you. You can check out the video we've made previously where we experienced trading Forex with and without a stop loss. Well, if the buy stop order is triggered, we proceed to cancel the other pending order. I'll leave the exit strategy to you, but in my opinion, you can opt for at least a 1 to 1.4 risk to reward ratio. And once you hit the take profit, simply close a part of your trade and activate the trailing stop to capture the maximum number of pips. You can look for a higher risk to reward ratio if you believe that the market is trending. There are many characteristics of strong trends. The most obvious one is that they run from one corner of your chart to the diagonally opposite corner with only small pullbacks. However, in the earlier stages of a trend, some signs indicate that the move is strong and likely to last. Other than that, there are other signs that you're looking at a strong trend, especially when you notice multiple sideways corrections after a trendline break and bars with a small or no tail in either direction. Let's look at this example. We can easily spot a well-structured channel here. Following our strategy, we should place 2 pending orders at 10 pips above and below the channel. The order to sell gets triggered first, and almost immediately we place the stop loss level at the high of the channel. We can see that the trend was strong enough to allow us to quickly hit the take profit level. As with all price trends, the tendency within a price channel must also come to an eventual end. We have a channel breakout when the price goes through its upper or lower limits and closes beyond that level. In this manner, the price action exits the channel and ceases to conform to its previous contained structure. Another strategy that you can use to define your take profit is by using the support and resistance levels. The rule of thumb is simple. If you're on a long trade, make sure that your take profit is not above the resistance or swing high. Avoid having technical, historical, and psychological levels between your entry and take profit. You can draw the key levels to help you define a solid setup, but if you're working on multiple charts, you can use one of the free indicators on TradingView that automatically add the key levels to the chart. I recommend using a free indicator called Swing High Low Support and Resistance by PatternSmart. This indicator will show you any key level that might prevent the price from hitting your take profit level. Remember that we are working on a 15-minute time frame, so the faster you close the trade, the better, as we don't want to bear the rollover cost or remain in the market for quite a long time. You can see in this example that the price had to break these previous key levels before it hits the take profit, and this is one of the reasons why the trade was running for quite some time. That's it for today. Let us know in the comments section if you have any questions about this strategy, and feel free to check out the other videos available on this channel. Happy trading!